are such an asshole.
All right, just bear with me. I have my notes here on my phone because I did the research while I was in bed one night. And where the heck? I couldn't have had possibly this many notes. Did I write it down on a piece of paper? Minneapolis passes rent control. Teachable. That's the world loves moms. Intro. Boo boo doo boo doo. Where did my notes go about Dan? God darn it. All right. I'll go from memory because it was kind of a clever idea. So I had to do a little bit of research on it and think about, oh yeah, I see what he's trying to do. So hi, Aaron, just to be brief, what are your thoughts on Dan Pena's, I think that's how you pronounce it, QLA strategy for building long-term wealth or generational wealth, as he puts it. I know you've done a Clary test on him maybe 3 to 4 years ago where he scored a 0 on account of having a good history. 0 is good, by the way, Dan, if you're tuning in. Please read a book, promote it. Having a good history, seeming like a cool and badass guy, giving out good bit of wisdom, but there aren't any red flags that catch my eye. Most notably, he offers a week-long seminar in his Guthrie Castle where he charges around 30,000 pounds, which is like 50 grand, as well as some of his top mentees just being online marketers, guys like Dan Locke, Brian Rose, and JC Capital. Okay, what a name like that, JC Capital. That's not his real name. My name is Aaron Finance. His method is essentially the concept of private equity at the micro level, where you assemble a dream team of comprised of executives of your chosen industry, as well as lawyers and accountants, then perform mergers and acquisitions, mostly acquisitions of small businesses, and over time selling your industry roll-ups for a profit, with your dream team getting a cut. The loans are basically a mix of seller financing and commercial loans. Seems like it's a situation that is very difficult yet possible for 1 to 10% of people, but also smells like a bit of a scam. I would also trust you to look into this briefly. I said, explain the financing, where money come from. Also, if you are the CEO of this micro private equity group, does this assume you also have experience in the industry you're in? Money is mostly via commercial loans. Dan talks about cold calling and meeting hundreds of bankers to find a worthless Kuanta to get you a loan. And I watched a video or two of Dan that was like, oh man, he's a pissed off old version of me. Look at that. And he doesn't have to work no more. He's old. He's retired. He could retire if he wanted. He's still going. And I like the fact he's got a pinstripe suit. He's a character. I was like, yeah, I can see this guy. So so there, what's he doing now? He's still working. All right. So that's good. Most loans made in the last quarter of the year, because a lot of these loan officers have quotas to meet and want that annual bonus. The rest would be from seller financing. It should also be worth noting that his method relies on purchasing businesses with a proven track record and trying to get them at a discount, targeting motivated sellers who would be eager to sell with no heir to run the business. Yeah, boy, the stars got on line for that one, to get a proven track record company that cash flows, let alone with a significant margin, and there's a motivated buyer. I think, who was it? Someone was paying attention to the Obits. Who was that? Someone I know in my past. You would pay attention to Obits. Was it Define Rent New York City? Was that it? No. Generally, as for the experience, generally, no. That is the whole premise of bringing in industry experts. Oh, okay. Well, let me try and remember the notes that I had taken. All right. Well, what we're trying to do here is you're basically you're going from very micro cap, the smallest unit of a company that you can, and then moving up to small cap. All right. And there's a couple reasons for that. What your real job is you're trying to bump up the liquidity of sellers or purchasers. You're trying to get into a more liquid market where more money per sale of dollar or per earnings dollar that this company generates, that if, one company, the big fish aren't really that interested in that one little company. But if you roll up 5 little companies into not such a little company, now some of the bigger venture capital firms, and not even venture capital, but small investment banks, sizable investors, they might pay attention. You know, it kind of think of it in terms of acquisitions. Like if you just got one branch bank, no one cares about podunk savings and loans. But if you get a regional bank going on, all of a sudden Wells Fargo money's looking at you, Bank of America money looking at you. So a lot more money. And you could kind of see this in the difference between private and public deals. Public deals, like now this is back in the day when I was young and handsome and pretty. I think the PE ratio for a private deal was like if you wanted to buy a company in public, you know, IPO, publicly traded shares, you're paying like a PE of 20. And then if there's a private company that wanted to get bought out, you would do the same valuation, but because it wasn't publicly traded and therefore not as facing as liquid of a buying market, you'd price it like at a discount of 25%. So a PE of 15. Now, I don't know what the PE ratios now are because I don't pay attention to news and we no longer care about fundamental investing. Matter of fact, you're probably getting better deals in private investing because there you actually pay attention to cash flow. And I'm kind of sure your banks would require that. So the public trade is just like inflation hedging. What are we at? PE of 100, 120? What is the PE now? Tell me, Wall Street investment gurus. So from a fundamental standpoint, this is better than just if you're a fundamental investor investing in the S&P 500. But no one invests in the S&P 500 anymore because of fundamentals or cash flow. So, and he's not wrong. This is it's right. I've never really thought of it that way, where you're making basically a conglomerate of little companies into a sizable one and then selling it. And then there's also, and this is why I asked if you were the CEO, if you're the head of this acquisition, do you have any experience? And before you go on to saying no, he says you don't need experience. I'm like, well, that's where I disagree. But if you had experience, like you were running your company, well, then you would know how to, you cut. And this is classic mergers and acquisitions. You only need one CEO. You only need a couple of vice presidents. You don't need all these middle managers. You're combining two armies and you're getting rid of half your generals, half your colonels, half your majors, and most of your captains, or half your captains, and you keep your sergeants and your soldiers around. And so you just cut out all that fat and you're streamlining the leverage managerial efficiencies. And so this is kind of the same thing here. So then your margins go up, your sales go up, your earnings go up, adjusting for the size of the firm even. And now you have not only a larger, but a much more profitable firm. And there's other synergies involved. I hate to use that word, but that's what it is. All of a sudden, you got access to all these markets. Like, oh, well, we got a product over here in California that did real well, but we never left California because it's a mom and pa shop. Hey, let's produce the widget that mom and pa did and sell it now to the 5 states that we're in. And so there's more than just cutting fat, streamlining management, and increase liquidity of a purchaser's market. There's other efficiencies that can be gained as well from economies of scale. So the fundamental, and here's where I would disagree. If you would have to know what you're doing. You would just have to, because ultimately you got to manage these companies. You cannot, companies are not, I saw so many people do this in business. Well, that's what my accountant is for. That's what the general manager. And it's like, no, you're the general manager. You don't hire a general manager, and you're an idiot for hiring. If you're a business idea, I want to become an entrepreneur. So I'm going to buy a restaurant. I'm going to be a general manager. Okay. Why would you do that? Well, then they manage the company for me. Well, why don't you just invest in an index fund that invests in restaurants? Because you're not managing anything. And all these idiots, I want to be called a business owner. I want to be called a business owner. All right. So then you buy a restaurant that you have no intention of managing. And then, you could see this. With Gordon Ramsay and the bar rescue guy. I love those guys both. Where it's, I don't have it. I just own the place. I don't, and they're drinking while they're not managing the place. And those companies go belly up. You will manage the company. You must know, so that you can identify, we fire Frank and Bill. Like, here are the metrics. and I just bought 5 companies, and we're going to take the best one with it. Okay, from company C, you got the best metrics. You're now whatever, president or vice president of marketing. Or you're the best accountant at company A. You're now in charge of all this. You need to participate. You need to know what the heck you're doing. If for any other reason, know the lay of the land and the future, or estimate the future of that particular industry. And fine, you can get lawyers and accountants and CPAs. I'm all for that. But the only way you could do that and not be an active, hands-on CEO, experienced manager of all this is you'd have, like you surmise, like 1 to 10%. And here's where, yeah, you would hire, it wouldn't be you or me, but you'd have lots of money. You could put a significant amount down. You got connections, and you could pay a decent salary or a wage. Well, I guess you pay out in equity. And it's legit. It's theoretically not only feasible, I'd say it's legit. It's, yes, you could do all these things, and that's what private equity people do. But I'll tell you this, man, you know what? It sounds like a lot of work. Sounds like a lot of work. And here's where me and Dan would probably not disagree. We just have different aims. I am all for not working. I'm for having fun. I work hard so I can go have fun and retire early. Dan enjoys working. He enjoys doing this. This is Dan's life. Dan loves this. He probably, what else would he'd be doing this? So his goals are different than mine. But if you want to have fun, and Dan's having fun, I'm not saying he's not. But if you're like, well, I'd like to make money and have it be passive, this is not for you. It sounds like a lot of work and a lot of phone calls and a lot of people screwing things up. And generally speaking, I'd be somewhat reluctant to do this because I don't know if you've noticed, your average American is a freaking moron. And the efficacy and efficiency of companies are going down. So I would definitely wait until the supply chain thing gets fixed and then see just how dysfunctional, whether the shelves get stocked still, or if now we're just dealing with idiocracy, genuine idiocracy, where people just, okay, all the boats have been unloaded now in Los Angeles. What's going on? We're still dysfunctional. Oh, yeah, you got to pee. And I would never run a company with employees. I would never buy a company with employees. And the heck if I'm going to buy 5 companies and try and consolidate them into one. No way. I wouldn't do it. Now, if you're rich or you're well off and you're thinking, and that's your joy, yeah, okay, it's an interesting way to do it. And by gosh, you could make a lot of wealth, make a lot of people rich. You can employ a lot more people. But when you be firing people, yeah, you get rid of the fat, but then you become more efficient. Then you expand, and then you hire other people. And you produce even more goods and services for the same amount of labor. But yeah, I mean, if you're just a younger guy and you're just starting out, no, this isn't for you. I'd either wait till like you got money on hand, or you are like in an industry and you smell like this might be the way to do things. Yeah, then it might be worth it. Like if you're on like, I bet you I get, because here's the thing. Unless you came from an investment banking background and you're a small entrepreneur, you know how to do that one thing really well. You don't understand mergers and acquisitions. You don't understand leverage. You don't understand synergies and consolidations. But if you understand that and you get a fair accounting background, and you grew up, being a mechanic, you know what? Most mechanics I know, whack those numbers. Well, I need numbers for more money in the bank than there was yesterday. Hey, can I get a loan? That's your competition. I mean, you could find some pretty stupid people in some pretty stupid industries, and then you could buy them out on pennies on the dollars, get the assets, and all of a sudden you start, Frank's Auto Shop, and you get a logo, and now you're located in the Tri-County area because you bought out Jessup and what's another Jebediah. We need numbers for. I got my 8th grade education. Need no numbers. My second wife, she does that in crayon. Never had crayon, but I did have someone just write. Never mind. It's not worth the time. All right. So there you go. All right. Joe Allen, $2. Dan, no, he's not. No, I don't believe so. Not if he's charging 30,000 pounds. I don't. Dude, if I could charge 30,000 pounds for a thing to come to my castle. Joe Allen, are entrepreneurs born or made? I'd say some of both. Like entrepreneurs can be born personality and made. Like I didn't want to be an entrepreneur, but I was forced to. I was forced into entrepreneurship. Because let's just admit it, boomers, especially in finance, are scum and need to go away if you catch my drift, because they're the ones that get bailed out. Yeah, I think you see a lot of young people being forced into entrepreneurship, whether that could be something as simple as OnlyFans or internet stuff, social media type of people. I mean, it's not real business. It's not a real job, but it is entrepreneurship. Fresh and fit, and I got the shirt on. People think I'm big fans. I am. I like Myron and Walter, but I wear this because this is the one hot sweatshirt I got. Django Geek, $5. If you were 15 years younger, knowing what you know now, would you pay 20,000 to be 6 feet taller? So 15, I would have been 21. I'm just trying to figure out how much time and effort. 21. No, I was 31. I'm doing the math wrong. 31. No, I wouldn't, because it wouldn't be worth 20 grand. By the age of 31, I was already kind of red pilled and was not that interested in girls. And shorter version, I had put forth the majority of my effort in the pursuit of women by that time, like 90%. I chased very few girls after 31 because I was burnt out. So that would not have helped me. Now, if I was 21, yes, I would have, because there would have been a payoff. But 31, not only was I burnt out, player burnout, women had lost their veneer. Women had lost their shine. I lost most of my interest in women. Not that I went after men. I just I figured out, I peered behind the curtain. I'm like, oh, and I had enough. And it's just like, yeah. And I know it sounds cheap or dirty. It's like, no, just pay for it, because it's not, I don't hate women or anything, but it's like, no, I'm not wasting my time and my money. There's still sex involved. But as I got older, it made very clear sense to me why seeking arrangement exists, why prostitution has always existed. And you too will get to that point where you're like, yeah, if you had to, you would pay. You will get to that point. Although I can't claim that. I know people are on their 4th and 5th marriages. Like, did you not learn anything? Apparently not. But yeah, I would not pay 20. What could you get? I mean, let's talk opportunity cost. What could you get? That's 40 high-end ladies of the evening. And just so you know, we are pro sex worker here over in the Cappy sphere. 40. Vince H, $5 for the legendary hat. Thank you. Yes. And I spent $6.74 on it. So $1.74 more. And the hat will have been paid by super chats. And I'll know what it's like to be a stripper. Yeah, Captain Lost. It's amazing how age and a good career around 30 reveals. Yeah. Yep. I cannot emphasize, I don't know why I didn't discover that longer, but past 3 months, I didn't realize what value there was in having opportunity cost. Once you have opportunity cost, everything gets really sharply into focus. When you're a 22-year-old kid and your opportunity cost is $12 an hour working security, you got nothing else in life, man. Nothing else. All right, that's it. Questions, answers, assholeconsulting.com. I'll see you guys later. Toodles.